Good afternoon, everybody. Let's do it. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Position disclosure. Where have all my longs gone? Following game plan. Paring out of some of these longs on the way up here. Still have some on. Market keeps going up. When are we going to stop going up? I don't know. It's getting crazy. We had another day of similar follow through to the days that we have seen where the market was also otherwise extended. And that short term tactical sentiment indicator that we like to look at was in the red. Where's Pat's note? Got it here somewhere. There it is. Pat's note from this morning. Again, just showing us short term tactical here is in the red. Gone over this a lot, probably especially recently because we've spent like almost as many trading sessions in the red zone here as we have outside of it. When we get into this red zone, it's more of a signal to me not to short than it is for me. Wait, did I say that right? It's more of a signal to me not to buy than it is to come in and short, because we've gotten, and you can even see here, like multiple days of this kind of being up in the red, and this is as of Friday's close. I'm assuming this is going to be in the red again tomorrow, so it's going to be, once again, we're looking at 2 or 3 trading sessions where we're in the red. But what's happened on these other days, and it's happened on a couple other occasions of this bear market rally, and I can show you on the charts where this like coupling of 3 days in a row of short-term tacticals in the red and this one here, 3 days in a row, actually happens on the chart, because the same price action has occurred on day 2 and day 3, on both of those occasions, and it occurred again today on the day 2. So again, a lot of times when that's in that red zone, it doesn't mean, hey, let's come in and short. It means you got to be very careful on your longs. And what we've seen is when we get continuation when that's in the red, usually the day begins with price and time correction. And the periods in that short-term tactical sentiment indicator that correspond to the market price action are these 3 days. That's this first bundle here. Let me bring Pat's note back up. This bundle right here corresponds with these 3 days. And that second bundle of 3 days in the red zone is these 3 days. And again, what happened on day 2 here and day 3, and day 2 here, and honestly maybe not as much day 3 here because that was Apple Amazon earnings, is that in the beginning of the day, we would see a lot of price correction, a lot of time correction. On each one of these days, we didn't wake up until like somewhere between 10:30 and noon. And then the market kind of broke its opening high and went into an upside grind. It's been the same thing every time. Today was the exact same situation. Friday was, honestly, to me, Friday was like a mind-blowingly strong day. Because if you remember Thursday last week, it looked like we were having some upside failure. Thursday last week, market got extended. It pulled back, closed kind of weak. The IWM in particular on Thursday last week gave us a shooting star. When you have a shooting star in extended territory, and you can refer back to my candlestick class, when you have a shooting star in extended territory, or a hammer, it would be the opposite of it, and the very next day they negate it, that's a signal of just like extreme bullishness in this case. If it was a hammer and it breaks the next day, it's like extreme bearishness. And usually you do see pretty good follow through after that. So incredible to me. I remember my mind was just blown on Friday, and I wasn't fighting the trend at all. I was just letting my longs pay me. I don't think I did any short selling at all on Friday. I remember my mind being blown that the IWM was able to, on Friday, get above Thursday's high, that the SPYs were able to do the same thing, and the Qs were weaker, and they like finally got to it into the close. And now again, we're seeing the upside follow through. Like I'm talking about with the intraday price action, look at the beginning of the day today. Beginning of the day, and this is for the SPYs. We had a gap down, so that helps kind of satisfy a little bit of that short-term tactical sentiment. We did fill that gap, but that was a peak, and we actually called out a short here, which is an okay short-term short. It eventually would have stopped you out. We called out a short off of this for the spies and the Qs. We pulled back. You just look at this choppy price action, just nothing's going on, and then we kind of break our opening high at 1140. And then it just once again triggers this like upside grind. And that this is the exact same price action that we saw on July 20th, July 21st, and July 28th for sure when we were in similar situations. And now here we are at the end of the day. Look at the SPYs almost back to their 200-day. Very impressive. 200 days still kind of declining. So it does tend to mean that your big picture rallies will fail. When I'm looking at the SPYs here at 428.60 right now with the ADMA at 419.50, so extended by $9 to the upside. The Qs, I start getting a little bit excited for a Q short, just an extension trade, and I've done it on the way up here on a few occasions with some success. As the Qs begin to approach $10 away from the ADMA, it's given me success shorting. So I finally shorted a little bit of that TQQQ into the close today. And I'm describing it as a hedge. That might not even be fully honest. It is a little bit of a hedge because I do still have longs. But I am so pared back on my longs at this point in this rally. I still have enough on to pay me if we're going to get a couple more upside days here. But I'm so, pulled back on my longs. I don't really need to have any hedge. I don't need to have a short on to reduce my exposure. It really is. It's like partially a hedge, but it's also certainly a trade. And it could be a little bit early. We definitely could see a day 3 because, again, those other times I'm instancing, we had a day 3 and then we had a pullback. We had a day 3 and then we had time correction. This was so strong here at the very end of July and beginning of August. But even after this 3-day move, we had 2 days of time correction before continuation, then 5 days of time correction before continuation. So I could easily be a bit early here. We could see a similar situation tomorrow. I mean, we could see a similar situation tomorrow where we gap down, like the exact same play as today. We gap down tomorrow morning. I get paid a little bit on my TQQQ short. I will take some off into a gap down, I think. And then we have similar price action where we chop around for half the day. We satisfy that short time frame upside extension and then give upside continuation to a day 3. But it's starting to feel like it's the pace and the degree of this rally is, I think, starting to become unsustainable. And I'm mincing my words here a little bit because the flip side of that is the same market dynamic price action that we've been looking at, and always that concept that a market can remain irrational for longer than you can remain solvent. And look, I'm generally a bull. I think people know that. I was certainly bullish. Back here into the back half of May, June, and July. Once we saw back in mid-May into June that the market made new lows, but a lot of those growth stocks were basing and didn't make new lows. That was the beginning of me kind of becoming more bullish on the market, and it still took like a couple months for this thing to play out and for us to be able to get this rally. But I don't know. It's the degree of the rally and the pace in which it's happened is getting a little bit crazy. But it's market dynamics. So we could continue. We really could continue. We could have one more big upside leg. And that's what I was really starting to think on Friday when this market has become so relentless that after you have an extended shooting star on the daily chart in the IWM that you still can't pull back. I'm starting to look for more of like upside capitulation. I think we've even started to see some degrees of it. But like everyone at the bottom? Well, it can't be a bottom because there's been no capitulation. There's been no capitulation. Well, I'm starting to look for upside capitulation, some sort of blow off top coming in on this market, which again, that could mean, that could mean 4 big days of upside to start this week, something like that. Into 340 here for the Qs, into 342 for the Qs, that 200-day even before a pullback, where I could be, sitting here way too early on my short. But I'm fine with it. I'm fine with my game plan for it. I'm not being super aggressive. It's something that I'll kind of build in and build out of a little bit. It's purely based off the market extension. And as the market becomes less extended, I'll be pairing out of that trade in one form or another. If the market becomes more extended, then I'll probably get a little bit heavier. So that's what I'm thinking about with that. Overall, though, it did turn out to be a relatively boring trading session. We spent the whole morning, like I was just saying, pricing time correcting before kind of the infinite bid came back into the market and we grinded up. I did some things well today, personally. Felt like I had some good calls, but like I was saying to Pat in the chat, I also felt like I was a little bit too loose on my trading. It definitely, and I'm pretty good at not doing this for the most part, but it's starting to creep in a little bit. And I'll tell you, I know myself well. This always starts to creep in a little bit on my trading when I've been doing well, and I really need to make sure that I don't, let those demons control me. It starts to become, sometimes I can just be like, oh, well, you've made so much money recently, like, who cares if I just take this trade and lose $500 in it. And that's not the right thought process. $500 is $500. It doesn't matter how much I'm up going into it. I can't just throw money into the garbage. So today was mixed for me personally. I felt like I had some great call outs in the morning. And then it was more like once we got past that morning session, I was just like doing some more boredom type stuff that really wasn't great for me. But starting with the good stuff, we talked about apron. I didn't bring it up in the morning meeting, but right when I got on the radio, right before the market was about to open, I said, oh, hey, and this apron possibly is a trade through $4. This thing's been relatively strong all morning. The market was gapping down, and this thing's been green all morning and kind of was already on my radar because I already have a position on it. So the trade through $4 that I was kind of calling out in real time worked out really well just off the opening low. You got like 6-7 cents worth of risk here, a little bit extended initially, but that ADMA put up pretty quickly. And then the follow through on this is fantastic. $4 stock here, 6-7 cents risk. By the end of the day, giving you 80 cents worth of reward. This was certainly my kind of trade of the day. It was my biggest P&L of the day today, which is just crazy. The Blue Apron of all companies is giving me days worth my biggest P&L. So that was a pretty solid kind of team call out there. So I hope some other folks got involved in this with me. And then this one certainly has squeeze ability. The short float in this is pretty large, I'm pretty sure. And I remember Stefan, who should be back, I think, in the VTF tomorrow from his extended vacation and that race he was doing in Finland. He was talking about how the CEO was involved in a capital raise of $12 a share. And that was one of the things that really kind of put it on his radar. And I've been trading this pretty consistently since June. His first squeeze up to $5, 350 was a big level. Pulled back a little bit more than I wanted it to. I got out of the majority of the position. I got back in on that earnings day, which I remember calling out. I think that was this day. I got back in pre-market that day at like 276. They traded it down pre-market on the report. I remember looking at the report. Actually, that might have been this day, this volume day here, where it opens up at 303 and the volume comes in a little bit. It's a little bit of a bigger candle. I remember just like reloading up in this thing pre-market at like 275, 280, something like that. It's just been a sick run from that ever since. So apron was a really good one for me. We called out this pivot low and snap very early on. What was that? Was that off this candle? Or was that off this candle? Right, this is apron. Like, this doesn't look right. This pivot low and snap. Similar situation, right? Just seeing that this name is green first, seeing that it's relatively strong first, seeing the technical pullback into the ADMA on the 5-minute chart. That's just like a kind of a bread and butter trade. I was a little bit nervous about the market for good reason. We're taking new longs. We discussed in the morning meeting, and you got to be careful with your new longs. When your short-term tactical is in the red zone and the market's extended. But what does this thing have on its side? It's got relative strength. Look how fast this thing was able to go green. It's the same thing that put apron on my radar. It was just the fact that apron was green pre-market. Spies here are struggling to get back to, beginning to fill their gap on the first 5-minute bar. Qs were a little bit stronger, but the snap basically opened and was one of the first things I saw go green. Pulled back here into that ADMA on the 5-minute, gave a pivot, so you go long versus the pivot. This is a excuse me. This is a potential continuation hammer. So continuation hammer basically means continuation of trend. So you just go long versus this low. And, this pullback here is a little bit dicey, but it's still kind of held with a 15-minute correction, and then you give an upside grind. I liquidated my snap position entirely into the close today. I will probably look to rebuy a dip. Honestly, most of the names that I've gotten out of, I have an interest in buying a dip. Just at this point, with the degree of the rally, I'm just managing my positions the way that I've game planned. So I'm getting out here, and I'll look to reassess those positions if and when this market eventually gives us some sort of real correction. And I think that the real true bull case at this point for the market, not to get off topic on the individual stocks, is actually when the real pullback happens, that will happen eventually, and we see a 3 to 5% down move kind of come in on the market over the course of, it doesn't happen to be one day, it could be over the course of a week or something like that. And then the market makes a true higher low on a first real testable pullback and then begins to work its way back up. I think that's like the true bull case as far as technicals go. I don't think that there's a great technical bull case to be had of this, bear market rally that we've kind of been in, just basically lasting forever. So we'll see if a real pullback happens and we get maybe a continuation hammer on the market itself at a certain point on a deep pullback. But like I'm out of Snap, I'm out of Amazon, I'm out of Google, I'm out of Netflix. I'm out of Pinterest now. Also, I got out of Pinterest in today's move. So yeah, we'll continue to watch all that. I'm trying to think if there was anything else from today. The XLE call I had was solid. To give myself some credit off of this hammer on the pullback. It pulled back a little bit too much, which means I've got a little bit lower probability of success. The flip side of a lower probability of success means that I've got a better risk reward. The risk on getting in on this pullback was solid. I don't remember my exact price, but it was like, what's this low? 94 cents. I think I had like $75.10 on it. So took a counter trend trade, got my risk covered, sold more at the ADMA, and then I basically, once it confirmed reversal, trailed this thing the entirety of the day. And I just decided I didn't want to swing it either. The daily chart is still a little bit sloppy, so I liquidated this one into the close also. But that was solid. And then, where I was making my mistakes was just kind of jumping into random stuff. I made a keystroke in one thing. I got involved in this ILAG that got called out. And I held in through this pullback. I actually got stopped out and re-entered. And then I just pressed the wrong button, I think, on this bar, and liquidated my entire position. Yeah, so I got stopped out. I re-entered the position, and I pressed the wrong button and liquidated my position. And I just kind of looked at it and I said, I'm just making stuff up and doing boredom trades anyway. Like I keystroked out of it, but I didn't really want the position anyway. I was just trading for the sake of trading. I'm not going to get back in. So then, of course, I missed, this entire move. I put the risk on, pressed the wrong button. You could argue that there's multiple mistakes here. You could argue that I shouldn't have been involved in it to begin with. That's probably the best argument that could be made if it just isn't my bread and butter and I don't know the company and I don't know what's going on with this thing. I don't know what the float looks like. I could be getting involved in another thing that could juice, or I could be getting involved in another pump and dump thing. I just didn't have enough information. Which is like, oh yeah, with this thing, the volume's picking up and it's moving higher, so I'm going to get involved in it. And then, the second mistake is I put the risk on. Like I would say, buy the ticket, take the ride. I put the risk on. I pressed the wrong stupid button, which, still happens to me every once in a while. It happens to everybody every once in a while. I know for newer traders, it happens probably a little more often than you'd like. Pressed the wrong button, liquidated the position at $3.32, I think, on this bar, and then didn't get back involved, and then the thing just ripped for $1. So I put on the full risk on this thing, ended up taking a very small loss on it, almost break even, at the point where I pressed the wrong button, and it was just silly. And then I felt like that gave me bad psychology, where then I was kind of messing around with this MEGL a little bit, and made just a couple dollars in it, but I honestly didn't trade it properly. And then I was trading this para here, and this one I solidly lost money in. When that news kind of came out, I traded a little bit, and it's a relatively small loss because my size was very in control, and it didn't pull back that much against me. But I got stopped out of this when these inside bars broke here, basically. Had a little bit added, but I didn't have a great price, and wasn't able to fully get my risk covered. My offer here, this high was 90 cents. My offer was like 94 cents to have my risk covered, so I didn't quite get that risk covered, and I got stopped out. So that one was a loss. So net up some money today. Nothing to write home about, but I don't know. I have been doing this for a long time, so I get frustrated with myself pretty easily when I feel like I'm not trading perfectly. And I did some really good stuff early on in the day, like that apron, the XLE, the snap call out, and then I was just kind of doing some silly stuff and some boredom trades and making mistakes and trading some things improperly that caused me to give back money unnecessarily and throw a little bit of money in the garbage. So I can't be doing that. Can't be doing that. No one else can be doing that either. And but I always keep it real with you guys, right? I like to go over the things I do properly and the things I do improperly. So there was probably some bad psychology in there on my part at a certain point that got me trading some things I shouldn't have been trading, and I've been in this game for too long to make those kinds of mistakes. So I hope that's something that everybody can learn from my errors. That's all I got. I am happy to take a look at anything that you guys got. So let me scroll up here on the VTF. First thing I'm seeing is from Chinggis. What are your thoughts on a trade on Friday, the 12th, in the Qs? It's a 10:05 inside candle, and the 11:05 inside candle for Friday. So I didn't come into Friday, even though it turned out to be a massively bullish day, and I was long and I made money long. I didn't really come into that day with like a heavily bullish bias. But let's take a look at the spots that you're talking about here. I like this first one, to be honest, because you just kind of had a technical pullback, and I think that was when the it was like a sentiment number or something came out. I think Friday at 10 o'clock that tipped us down real quick and tailed us back up. So ticked us down for like a 15-minute correction there, or the 21 EMA on the 5-minute. The bar after that's an inside 5. The inside 5 breaks to the upside. It's still early enough in the day where that inside 5 breaking to the upside, you are getting above the high of the 10 a.m. number. So it makes all these things I'm mentioning make me like this. And then you're breaking above kind of the intraday resistance where you're looking for continuation. This pullback here at 10:45 is probably a little bit deeper than you want, but you don't get stopped out. Whether you're using the inside 5 low or the absolute pivot low as your stop, you're not getting stopped out on this pullback, and that's a trigger to be in the trade potentially all day. The 11:05 candle that you're referencing, I don't like as much. It's later in the day. You're closer to that midday point. The degree of this pullback here inclines me to think that there at that time became a higher probability of it just being a range day, even though we eventually broke up and kind of grinded up all day. So I don't like the time of the day. Like one of the things I liked about the first one, not just the time of the day, is that it's getting you above this news bar. That's an extra piece of information that kind of made me like that trade more. This one, I don't know. I know that if you trade every inside 5-minute candle that comes in the marketplace, particularly inside candles that are within a consolidation, that you will lose money in the long run. So you want to be taking those trades where there's the potential of trend continuation and or momentum continuation. And here for sure, you did have aspects of trend continuation with this inside 5, if that's leading to a break of highs. I don't know. And I'm trying very hard here to not look at what happened the rest of the day and utilize 2020 hindsight. I just think at this point in the day when you're taking this trade at 11 o'clock, that there was at least as high of a probability of this turning into a range day and us doing nothing and you just kind of getting shaken around by trading this type of bar at this time of day than actually getting the upside continuation that you got. So I'm down with the first one. I'm not loving the second one. From JK, if you have time today, could you please do a quick overview of after-hours trading execution? Sure. So there's just a couple basic things that you need to be aware of if you're trading in a professional account through T3 or a retail account through T3, where you have access to the market from 4 a.m. to 8 p.m. Eastern time. So we have the full, pre-market and full post-market. I think most retail accounts only give you starting at 7 a.m. We go back as early as 4 a.m. So there's a couple of things to pay attention to. First, you got to be very cautious on liquidity. All right, I'm just going to say that broadly. I know that's not execution, so it's not answering your question directly, but it's important that I kind of mention that warning. You got to be very cautious on your liquidity pre and post market. Most things don't have enough liquidity to be tradable. You don't want to accidentally press the button on something that has an insane spread. I remember when I was first starting my trading desk, back in like 2013, there was a stock called Precision Cast Parts, PCP, that I think Warren Buffett and Berkshire eventually bought them out. But that stock was so crazy. It was a little expensive. It always had this crazy spread. And I was getting, out of nowhere, this is when everybody was still on the desk, I was getting frantic phone calls from one of my traders at like 7:45 in the evening that he accidentally pressed his buy button hotkey, which almost shouldn't even be possible after hours because market orders don't work, and like paid up like 8%, like cross an 8% spread. And it was small, but it was an expensive stock. I think he bought like a couple hundred shares. He ended up taking like an $8,000 loss on this. And then he panicked, and he just liquidated the position on the complete other side of the spread. And there are rules where you can get trades broken if the print is too far away from the last print. But the algorithms that are providing liquidity after hours, they know what those rules are. I don't remember if it's 10% or 8% or what it is where you can get a trade broken if it's that far away from the last print. But the algorithms know that, so they're providing liquidity that is like just within that barrier. So we weren't able to get his trade broken. He bought the stock, liquidated it on the other side at like 7:45 at night. There was zero liquidity. He took like an $8,000 loss, and it was painful for him, and he was very upset and blowing my phone up. So you got to be very careful after hours is the point. Okay, so you're trading the SPYs, maybe you're trading the Qs, things that are very liquid. Trade an Apple. Pay attention to your spreads. Pay attention to liquidity. Next thing to know is on the actual execution, order types. Certain order types do not work pre and post market. Market orders do not work pre and post market. The literal term market order, it's an order in market hours, right? So if you have hotkeys for market buy and market sell that you maybe like to use to liquidate positions, they're not going to work. And most likely, your stop loss is connected to a market order. I know mine are. My buy stop and sell stop orders are set to my market keys. They route to my market keys for when they get triggered. So most likely, you're not going to be able to use stops after hours. You can't use market orders. You can't use stops. All you can do is limit orders. Now, limit orders can take the market still, and this is something that I think that people sometimes forget to realize. Here's my level 2 for Snap, which I can show because I'm no longer in this position as of today. So if I was trading Snap after hours, and let's say I'm long, and I want my stop loss, and you can't use stop losses, I want my stop loss to be at $12.15. That's my trade. I'm just making this up to keep it simple. I can't put a stop in. What I have to do is I have to take an offer, right? So this is my normal offer key. So like right now I could put an offer out to get short. Bam, I just put an offer out to get short for 100 shares at $12.44, right? That's my offer key. If I'm long, this is not going to be a short sale. It's going to be a long sale, right? So let's say I'm long the position already and I want to use $12.15 as my stop. What I'm doing is I'm taking an offer and I'm crossing it through where I would want to stop myself out. I can't just go to $12.15 because it's going to be trading through it. I'm going to get slippage, especially because it's after hours, and there's no liquidity. So if I wanted to get out of my long Snap trade basically what I am doing, this is why, sometimes when I'm trying to trade a little bit after hours and I'm trying to do an afternoon meeting at the same time, it's very difficult. If I want $12.15 to be my stop, I'm probably going to cross my limit order down to 11.90. And I am like watching this thing like a hawk with my finger on my enter button. And the second I see a print of $12.15, I'm pressing the enter button as fast as I can. Now this is going to be set to cross the market, right? It's going to cross. This is an offer to sell at 11.90. I want to press that button the second 12.15 gets hit. So if the inside bid at that point as I'm pressing the button is $12.10, I'm just going to get best price. I'll get $12.10. If the best bid is $12.05, I'm going to get $12.05. That's how I'm going to liquidate my position. So I'm crossing the market. That's how I'm trading it. And if I was trading like Apple after hours or Tesla after hours or something like that, I might have this limit order. I might have this thing crossed like dollars away. And I'm going to press my enter button as fast as I can to get stopped out, because you need to. One other piece of information to make it tricky, or to make it even trickier, is how you route your order. Certain exchanges stop working at certain times of the day. So, for example, New York Stock Exchange is only open from 9:30 to 4. So if I was going to route my order, if I'm set to route to New York Stock Exchange, and I just changed my route here to New York Stock Exchange, if I were to press enter, and I'm not going to experiment with it because it shouldn't do anything, but just in case, I really don't want to short any snap right here. But like New York Stock Exchange is not open. If I route a limit order, let me try to do it actually on the. Let me see if I can bid NYSE right now at 12 cents and see what happens. Nothing. Rejected. Yeah, the order got rejected. New York Stock Exchange is closed. So if I'm thinking, here I am, look at me, I'm going to trade after hours, I'm so cool. And, I'm routing to New York Stock Exchange, nothing's going to happen. Well, to make it trickier, some of the other ECNs turn off at different times. I think Edge, which is EdgeX and EdgeA, and BATS turn off at 6 p.m. I think. At least they definitely used to, unless that's changed. Whereas NASDAQ and ARCA continue through 8 p.m. Now, most of you, I think, if you got your hotkeys with help from Patrick, are set as NASDAQ as your primary routing exchange. And I know I am at this point too. For a long time it was BATS, for a long time it was ARCA, and now I finally made the switch over to NASDAQ. But you got to be careful if you're routing towards BATS or Edge, and it's 6:03, and oh my God, if you were trying to liquidate the position like I was just describing, and you were across the market, you press the button, it gets rejected because BATS is closed or whatever. Now you can't get out. So you need to know how you're routing, what certain types of keys don't work, what keys do work. So the moral of the story is, first of all, if you didn't follow any aspect of anything I just said, you have no business trading pre and post market. I typically recommend that traders do not trade pre and post market within the first year of their career. It's a broad recommendation. I'm not going to say that if you're 6 months into your career and you got a long swing on and you want to short a little bit of the QQQ pre-market. I'm not going to say that you can't do that. But as a general rule, I don't recommend that people are trading after hours, especially when they're newer traders, just because you got to know all this stuff. You got to know that your stops don't work. You got to know, that certain exchange routes aren't going to work. You got to know that there's much less liquidity. You really have to have an understanding of liquidity. And honestly, if you are trading after hours or pre-market, maybe you're doing it in the market a little bit, but a lot of that is you're trading earnings names. And the earnings names move so crazy when the reports come out. That's probably another reason why, if you're a new trader, you're potentially putting on a lot of risk. The worst thing that can happen, and I've seen it happen, is you're a new trader and you're like, hey, I'm going to trade whatever stock on its earnings report, and then you're messing up the stuff I'm talking about with the execution and routing isn't working properly. Now you're stuck in a position on an earnings report that's just moving against you like 1% every 5 seconds, and you're freaking out and you're panicking. And you're calling me at 6 o'clock in the morning, but my alarm hasn't woken up yet. Luckily, the trade support team, they usually have at least one member of the trade support team available between 4 a.m. and 8 p.m. So you can usually still probably get in touch with somebody, but you just got to be very careful with this stuff is kind of the bottom line. So thanks for the question, JK, and I hope that helps. Thanks, Gabriel. From Michael Jackson. SPY looking back as far as October. 429 level has been support in October and June. 429. Yeah, you can definitely see this 429 is a key kind of inflection area on both sides. You've got it in January, like you're saying. In October? Yeah, back here in like September, October also. And then it held as resistance in late April, early May. Yeah, so it's 429 area. It's a key inflection area as we're approaching this 200 day, which is declining at 431. So yeah, so we'll see what happens here. It's definitely an interesting spot. And I think it's very important, MJ, so I appreciate you bringing that up. From DJ, if the market's price action doesn't really align with your thesis game plan, do you think it's better to avoid trading or to adapt your game plan and continue looking for opportunities? Both at the same time, if that makes sense. So I think that it's okay if the market is not aligning with your thesis and your game plan to take a half step back to do less. At the same time, I think that you always have to recognize that the most important thing is the price action, and you can't be afraid to get paid on some stuff, right? Like, I mean, you all have seen me take AMC trades to the long side here over the course of the last several months. But you all know I'm a hater on this company. That does not align with my thesis. My thesis is this is a $3 stock. But I've taken it to the long side because the trading opportunities presented itself. My biggest thing is when the market's not aligning with my thesis, I do less, and what I do, I tend to do it much lighter. So like any AMC trade that I have taken to the long side here over the course of the last several months, if my thesis was the opposite, if I was a real AMC believer for whatever reason, because it's a great company and movies are the future and everyone wants to be in the movie theater or whatever it is, I probably would have taken those trades, with significant more size. I probably would have looked to swing more aggressively than I did. So I think that the answer is both. You want to first check the premises on your thesis and your game plan, because sometimes our thesis is incorrect and we need to make adjustments. But secondly, don't be afraid to take a half step back. Don't be afraid to sit in your hands a little bit more. Don't be afraid to trade less. But also, don't be afraid to just get paid based off the price action. So if the trade is there and the price action is there and it's confirming, you can put some risk on. But it's probably never going to be your A+ trade. Good stuff, Cap Holmes. Talk to you soon. Sounds good, JK. And Ahmed has a question about extension, like how I measure extension. So the way that I measure extension in the marketplace is the space between the 8 and 20 is how far the market is away from the space between the 8 and 21 EMA. So the space between the 8 and 21 EMA is the area that I consider to be technical equilibrium for the market. So right now the 8 EMA is at 419.55. The 21 EMA is at 409.39. So there's a pretty wide equilibrium here because the market's gone up so fast. But this entire area, it's $10. That space is the equilibrium zone. So if the market is trading above that equilibrium zone like it is right now, or trading below the equilibrium zone, then I have a market that's extended. And you could have a market that is like just barely extended, a little bit extended, a little bit more extended, a medium degree of extension, a lot of extension, or a massive amount of extension. And then to add on to it further, to make it a little bit trickier, it's more reasonable for certain types of stocks to have larger degrees of extension than others. So it's going to tend to be that like higher beta type names have the ability to become more extended than like a consumer staple. So like, and really the proper way to do it is in percentages, and I usually don't do it that way because my mental math on percentages honestly just isn't good enough to just be kind of constantly, consistently always saying, oh, we're this percent extended in the market at any point in time. But the point that I'm trying to get across is if I've got a growth stock that is 3% above the ADMA, and I've got a consumer staple like Procter and Gamble that is 3% above the ADMA, that 3% in Procter and Gamble is actually significantly more extension than 3% in Sunrun or DKNG or pick your growth stock. And that's because those growth stocks have such higher beta, they move so much faster. Consumer staples tend to not move very well. So on a relative basis for that stock, 3% extension above the ADMA is actually probably going to be more of an anomaly for a Procter and Gamble than it will be for a growth stock where it probably happens all the time. So, and you want to pay attention to again, degrees of extension. Technically, if the ADMA on the daily chart right now is 419.53, if I'm looking at the SPYs at 419.54, I'm extended. I'm extended the upside by 1 penny, which is absolutely nothing in a $419 ETF, right? Basically, like we would say it's not extended. We would say that's at equilibrium. It's a penny away from it. But if you want to be super technical about it, you're extended by a penny. Or if the market's at 420.52, we're extended by $1. Or right now, the market's at 428.40, we're extended by about $9. So those are going to be degrees of extension, and it matters, again, what you're looking at. Like, you tend to not see, I keep going back to the Qs, $10 is what I keep kind of saying. Like, you really tend to not see an index, right? This is not one individual stock. An individual stock can have news. I guess the market could have news also. But an individual stock can have news, it could have an earnings report, it could have something that gaps it up or down 20% and just has it become like significantly extended. You don't really ever see the NASDAQ gapping up or down 20%, right? That's just not going to happen. But an individual stock can do it. So, like in general, what I've kind of noticed here in this market, and this is something that changes and adjusts over time, is that every time the Qs get to be about $10 extended, it just becomes more away from the ADMA. It just becomes more than the market can kind of handle, and we get a price or time correction. That's kind of what I keep paying attention to. So right now, 324.80, market's at 333. Let's just call it. So we're extended by $8 to the upside in the Qs. Not quite at that $10 yet, but we're starting to get towards that maximum. Now the things that you got to remember is that extension can get fixed, if you will, in two ways. The market can pull back to it, and now the market's no longer extended. That's a price correction. Or the market can go sideways, and equilibrium catches up to it. That's a time correction. Time corrections tend to be more, in this case, bullish than price corrections, but either of them are fine. That's how trends are created. You get a market that gets extended, and then it pulls back to the equilibrium zone, and it finds a pivot somewhere in that equilibrium zone, and then it gets extended, and it gives, in this case, a time correction. This ADMA catches up. Like look at just 315 as an example of a time correction. The price 315 here for the Qs on the 29th, and the market's at 315, the ADMA is at 304.87. That's $10 extended. The next day, the ADMA is at 307. So now I'm $8 extended. The next day, when we're trading at 315, it's at almost 309. So now I'm $6 extended. So every time this market spends a day going sideways, this ADMA is catching up more and more and more and more. Where all of a sudden, in this case, we got a time correction. Then the market was able to give another leg here, get a little bit extended, and then kind of give another time/price correction a little bit with this pullback in this area before we have now broken out again. So understanding degrees of extension is important. It's very important strategically. Like I don't like buying extended stocks. I say it all the time. I don't like buying extended stocks in extended markets. I want to be buying the setup that's giving continuation. If I am buying an extended stock or an extended market, I need to recognize that I'm taking a pure momentum trade. And then you need to understand what the definition of momentum is. If you all remember, and you all should know this, like, even if it's like your first day on the team, there's three definitions that are extremely important to me: the definition of a trade, the definition of trend, and the definition of momentum. The definition of momentum, which is what we're talking about right now, is the greater the price, the greater the demand. It is momentum that creates extension. So if I'm buying a stock or a market that's already extended, I need to be taking a momentum trade. A momentum trade is a trade where you're basically buying high to sell higher. I'm buying, recognizing that it's extended, but I'm taking a momentum trade. I'm expecting momentum to be here. Momentum is the cause, the creation of extension. So the way that a extended market becomes more extended is through momentum. So I either want to be, building in a strong market, let's just say, into pullbacks and looking for continuation hammers, or looking for that inside and up pattern that I like for trend continuation. That's probably going to be where the better money is a lot, but not necessarily. Or I'm saying to myself, hey, you know what, this market's extended, but this stock's got relative strength, and I'm taking a pure momentum trade here because I think the volume can come in, and there's a high short float, and the shorts are going to get squeezed, and that's all the type of dynamic stuff that creates momentum, volume, short float, all that. When you're looking for your continuation there. So yeah, hope that helps, Ahmed. And that's a great question. It's a great review for everybody. Nice saying interesting day. The VIX and spot are up. Yeah, VIXY didn't trade well, but I know Pat, I think, was saying that the VVIX was up, which is notable. Sometimes you can see the VIX and the market moving together for like a couple of days in a row. But that's usually like a real signal. How did the dollar end up closing today? The dollar was very strong all day, right? Yeah, very strong today. It tends to be not great for the market. Yeah, we're certainly in an interesting market right here. I don't think that the way in which this market is moving up is going to be able to continue for significantly longer, but it could continue for longer than we expect. And I think the real test comes in on the first big pullback. So I think that's a good way to end it. Got another lab. I think this XBI looks great. I just start getting worried when I look at patterns that I like, when I start to think maybe the market can't be on my side anymore. And I'm like at the point here where like I'm looking at some of these patterns that we discussed in the morning meeting, like XBI. I'm looking at it and I'm like, man, I still really like how this XBI looks, but I'm concerned about fighting the market. That this is not going to be able to continue, as this pattern will fail entirely if the market really starts having a heavier pullback, which it's becoming due for. The flip side is, we have seen XBI trade completely independently to the market. So maybe the market pulls back and this XBI holds up like a champion. So this one I do still have the Labu. So kind of continuing to ride that one. I had said, I like to give myself a pat on the back every once in a while on calls that people might think are crazy. I remember when we were kind of buying this support back in here, I was saying that my target was going to be in the upper 90s, and now it doesn't seem very crazy, right? We're kind of almost there. So where are we on this Labu? I'm still looking for another like $3 of upside on this thing. To be honest, something like that. So we'll see. I was looking for something from one of your afternoon recaps over the weekend on YouTube, and I hit the wrong link and stumbled on my November 11th, 2011 recap. Around the 26-27 minute mark, you gave this trader psychology advice that I thought was excellent. Talking again about anticipating the trade and executing the trade plan. Just wanted to give you some positive feedback. Thank you for that, Bandit. And I guess it's great information for everybody else too. So if anybody wants a review on some trader psychology stuff, you can go back to the old meeting here that Bandit got some value out of from November 11th at about the 26-27 minute mark. So appreciate that feedback very much. And we'll end it at that point. So have a great night, everybody. I will see you all tomorrow.